Smartest Data, Warren William here. Quick definitions. Amortisation. So why is amortisation called a non-cash item? Is amortisation the same as depreciation? Let's go to the video and take a look at amortisation, and at the end of the video there'll be 3 quick bullet points to take away. Amortisation is a non-cash expense taken against the profit and loss for the reduction in the balance sheet valuation of intangible assets. Amortisation is an expense used in the preparation of the company's annual financial statements, and it is a non-cash item as there is no cash payment. As amortisation is recognised as an expense, it reduces the taxable income of a company while not impacting a company's tax position. An adjustment is made in preparing the cash flow statement. The purpose is to recognise the decreasing value of an intangible asset, and it has the effect of reducing the value of intangible assets on the balance sheet. An amortisation schedule will conform to GAAP or IFRS accounting standards. An intangible asset is an asset that cannot be touched, for example, goodwill, intellectual property, patents, copyrights, and trademarks. When applied to an asset, amortisation is similar to the depreciation of a fixed asset. Three takeaway bullet points regarding amortisation. Amortisation deals with intangible assets. Let's say it is the same concept of depreciation, which deals with fixed assets. It is a business expense, therefore it will reduce the taxable income of a company. It is a non-cash item, therefore there is no cash outflow and adjustment is made in the annual cash flow statement.